The great reset crash is coming. Here is why inflation was always the end game. There is beautiful irony in macroeconomics. Just when everyone thinks something is definitely true, it turns out to be spectacularly false. In fact, worse than that. The false belief usually sows the seeds of its own destruction. Our whole pseudoscience is susceptible to that famous Mark Twain quote, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." A lot of investors were prepared for a crash in 2021 after they saw the top, the same way that they saw it in the financial crisis, which is a deflationary crash. If you are one of those investors who believes deflation is the bigger risk, you probably got cleaned out by this inflation. The global elite from the Great Reset told us that you will own nothing and be happy. How are they going to achieve that? Are they going to cause a depression next? Or are they going to cause hyperinflation? Is the Great Reset crash coming? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? We see this most clearly in the long pendulum swings between fiscal and monetary orthodoxy. Just when the Keynesians think they have won the argument, they have to face their historic nemesis, stagflation. When policymakers think they can solve all the world's problems with monetary policy alone, they always end up in some version of the liquidity trap. Over the past decade, the 2008 crisis shocked everyone. As an industry, financial markets suffered a sort of collective PTSD. Investors spent the next decade looking for black swans that never arrived. The euro crisis in 2010, the debt limit in 2011, the euro crisis again in 2012, oil in 2014, China in 2014 and in 2016, and in 2019, and again in 2021. Mageddon in 2018, the thing that happened in repo markets that nobody fully understood in 2019. Southside economists analyzed every potential threat in excruciating detail, looking for that one problem their clients feared most, another Lehman moment, and policymakers reacted in the same hypersensitive way to every potential market threat. The authorities had their own PTSD to deal with. Nobody wanted to return to the crisis of 2008. With its chaotically arranged market communiques and rescue packages finalized at 4 a.m. At every opportunity, central banks cut interest rates and added more QE. Deep down, they knew these policies would do little to help their economies, but they seemed very effective at propping up asset prices. And with inflation showing no obvious signs of life, there was no real cost to this endless monetary lifeline. What harm would it do? Inflation didn't budge, in large part because fiscal policy was continuously and egregiously too tight. Only China, the one part of the world that weaponized its state balance sheet, was able to move the dial on the global CPI. But every brief burst of reflation quickly sizzled out as soon as the stimulus was reserved. Overall, the global fiscal monetary policy was deeply disinflationary. If yields at 800-year lows didn't make this point blindingly obvious, this point, negative nominal rates, which everyone scrambled to explain when they first appeared, should have settled the debate. Negative interest rates were the tell. When investors will pay governments for the privilege of lending them money. It is clear that the old rules of economics have broken down. Now there is no limit on government debt. And deflation takes over from inflation as the dominant challenge facing central banks. It is no wonder that MMT was winning in 2010s. When rates are zero, everything MMT says is true. MMT just reminded the mainstream things it had forgotten, and the mainstream resented it. After 5 years of investors asking me to identify the end of the cycle, the black swan arrived from something few had imagined. As is the way with black swans, the 2020 global crisis. By then, policymakers and investors had taken the new rules of the 2010s for granted. Secular stagflation would never end. Moderate inflation, let alone prices rising at double digits, was something that seemed unimaginable. So policymakers put everything they had learned into practice. Central banks immediately backstopped the shadow bank system. The Fed widened its swap lines for dollar liquidity, and governments, knowing that monetary policy would not be enough, launched their biggest fiscal support program since World War II. There were no questions about whether we could afford it anymore. And inflation was something only boomers cared about. The policy response was extremely successful. By freezing the credit cycle, bankruptcies fell to historic lows. The authorities prevented a depression. In the end, this was a supply shock, not just a demand shock. The combination of lockdowns and income support was highly inflationary, which the spasms and reflexivity of international supply chains amplified. For a while, there were good reasons to think this inflation episode would be transitory. Prices would not fall. Yet the supply problems continued. First in labor markets, and then with the war in Ukraine. Stagflation beckoned. For central banks, this was unacceptable. So they raise interest rates aggressively as if their credibility depended on it. No central banker wanted to become a case study in monetary failure. But governments will have different ideas. For elected officials, inflation is a cost of living crisis and a reason to provide fresh rounds of fiscal support, especially if and when central banks drive their economies into recession. And after the cost of living crisis, there will be further pressure on the public finances from climate change, ongoing energy shortages, decarbonomics, defense spending, and the emerging Cold War between the world's strategic geopolitical opponent. Despite what some pundits thought, Japan-style deflation was never the end game. For most democratic societies, inflation is only socially acceptable way out. As for the Great Reset crash, we just saw Bitcoin crash down 12% on the election day to a new low this year, when most stocks and bonds were green. That's a sign where it shows decentralized system is not stable. Also, that shows a lot of people believe financial conditions are tight. And the crash for stocks and bonds are coming real soon. It's an inflationary crash first. People will sell their assets at the bottom to buy food and gas. Then comes a deflationary crash when the war happens with China. They will open the money printer again, creating another inflationary cycle. Now I'm going to show you my client Tina Kadisha's book, Freedom, 7 Steps to Thrive in Life and Business. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It's an erotic novel. And my book, Time Awareness and Secret Millionaire. You are such a good boy for watching my video right till the end. Bye.